We are live. Hi everyone, welcome to Gulaq's October AMA webinar. We're just going to wait a couple more minutes till everybody joins, and then we'll start with what are the changes that we have done in the portfolio for October month, and we'll also be giving you the breakdown of returns for the previous months of September. In the meanwhile, if you guys have any questions, you can start sending those out in the comment section, and I'll make sure to ask them to Vivek either in between the webinar or towards the end once we have covered all the updates. All right, I guess we can start. People will start coming in as we move ahead. This stream would always be available on our YouTube, so in case you miss any part of it, you can always revisit. So, Vivek, if you can start with the presentation. So, agenda for today is we are going to tell you about ST and Gulaq if you haven't known us already, and then we'll give you the updates for October month. What are the portfolio changes we have done, and we'll also give you the breakdown of returns of previous month. And towards the end, we'll take questions. We have already received tons of questions. We'll answer some of those, and then we'll also take some live questions towards the end. So about ST, if you haven't known us already or if you are new to us, ST is one of the pioneers in systematic investing in India. It was founded in 2008, which was around the time when SEBI introduced or allowed systematic algorithmic trading in India. And we have been serving for over past 15 plus years. We have been serving institutionals and big HNI clients, helping them build financial wealth by providing them systematic quant-based portfolios. Operate in over 6 countries and have received NSE Institutional Member of the Year award in 2019. And over the board across all products, we have a little over 1,500 crores of AUM. Coming to Gulaq, Gulaq is our retail investment advisory arm of ST. So we use the same investment methodology and same process that we do in ST while serving institutional and HNI clients, and we just repackage it in a way that allows us to sell these portfolios to small case clients at a very affordable price. We have launched this initiative in 2020. We are registered, SEBI registered investment advisor, and we have in total to this day we have served over 27,000 clients. And our team includes Sandeep Tyagi, who is the founder and CEO of ST Advisors, and Gulaq. He's a BTech from IIT Delhi and also holds an MBA from Columbia Business School. He has over 30 years of experience in portfolio management, analytics, and consulting. And of course, Vivek. who's the speaker of this session. He is the investment head at Gulaq and ST. He has done his BTech and MTech from IIT Kharagpur and holds over 2 decades of experience in trading and investment management. And I am a senior analyst at ST Advisors, and I hold qualifications of ACCA, FRM, and CFA. So, disclaimers alert. ST Advisors is a registered research analyst, and you can see our registration number, SIN number, and our registered address all across this board. And this webinar is for educational purposes only and should not be treated as an investment advice in any order whatsoever. And we have also launched our WhatsApp channel. So if you haven't already joined it, you should join our WhatsApp channel. You can either scan this QR code in front of your screen, or I'm just going to share the link of the WhatsApp channel very shortly in the chat so that you can join it from them. We share investment principles, portfolio related updates, invitation to our webinars. So you must join this channel if you want to stay updated on all the events that happens at Gulaq. Over to you, Vivek.
Yeah, hi. Thank you, Ankit. So I'll start with, because there are many new investors also who have joined us in the last month, I'll just start with the gear-based philosophy that we have been following. So like the way we drive on roads, if the weather is clear, if there is not too much of traffic and you can see far ahead, then you would want to drive at a faster or a higher gear. Whereas if there's maybe too many potholes or the visibility is not there, then you would want to drive at lower gear. Another factor could be your risk profile. Some people generally just like to drive at much higher speeds, whereas some others would prefer a lower speed, irrespective of the conditions at road. Right. So similarly, we have these gears which have different risk and returns profile. So Gear 6 is meant for aggressive investors who in which what we have done is we have 100% equity. So it can obviously it has the potential to give you the highest returns, but also when the markets are volatile, it can show you the highest negative returns also. Gear 4 is for moderate to aggressive investors where we have added 20% debt and 80% is equity. The equity component remains the same in all these gears. So in Gear 4, because we have added this 20% debt, there is little bit of safety there. So it's going to be not as volatile as Gear 6. And the returns expectations from this also would be slightly lower than Gear 6. Gear 5 and Gear 4 and Gear 3 also have 20% additional debt. As you can see, Gear 4 has 60 equity, 40 debt, and Gear 3 has 40 equity, 60 debt. So for conservative investors, we have Gear 3. For moderate, it could be anywhere from Gear 3, 4, or even Gear 5. And for aggressive investors, it could be either Gear 5 or Gear 6, right? And as I told you, since the equity part is same, if let's say somebody is investing 100 rupees in Gear 4 and 100 in Gear 6, that's same as investing 200 rupees in Gear 5, right? Now, coming to the rebalance update, as you can see in October, we have reduced our large cap allocation to 13%, and mid cap allocation goes up to 53%, and small cap remains roughly the same at about 34%. Right. This is the rebalance update across sectors. So there are two ways to look at it. One is month on month, what is the change? So that's the delta last column, that's the weight. So if you see, we have increased our allocation to IT, consumer discretionary, materials, energy, and consumer staples, whereas we have reduced our allocation in financials and healthcare as compared to last month. Another way to look at it is where we stand as of now as compared to the index. And now the benchmark index is here, BSC 500 index. So if you see and compare that, we have the maximum allocation in consumer staples uh, in which BSE 500 has almost just about 7% allocation, whereas we are at 27%. Financials, even though we have 25%, but it's still lower than what the allocation of financials in BSE 500, which is 30. So we are pretty bullish on financial, but not as bullish as we would allocate in BSE 500. Healthcare, again, another sector where we are quite bullish, where we have 16% allocation still, but overall in BSE 500 you just have 6.4% allocation. Now this is the factor type that we have invested in. Uh, Value now remains the largest. It came down last month, but again it has shot up to 61%. And the rest of the weightage is to quality, and we have zero factor weightage to volatility, leverage, and momentum. All of these three are zero. It's just that value and quality we have invested in. Now, coming to the returns part, returns overall, if you see over long run since inception, they're pretty solid. They are at 42% versus Nifty has given 22%. This is since May 2020. So pretty healthy alpha we have produced almost 20%. So even after those costs, it's still very, very healthy. And that has been the trend over longer run. In the short run, 1 year returns, yes, we haven't been doing as well. So we have a negative alpha of 4%. So Nifty multi-cap has given 6.2, whereas we are at minus 10%. In the short run, depending on the time frame you look at, whether it's 1 month to 6 month, we are close to zero only. 6 months we are positive, 1 month we are negative. But overall, whenever you want to judge a specific active manager, you should definitely only look at slightly longer time frames, 1 year, 3 year, and 5 year. That's what I personally look at. Gear 5, again, it would be similar trend as that of Gear 6, because in this also we have about 80% equity. So over 1 year, it has underperformed a bit, about 2.2%, whereas over 2, 3, 4 years, it has given pretty solid returns. Gear 4, again, similar kind of trend. Over long run, we've done phenomenally well. Over 1 year or so, also it's slightly closer to break even only. And similar is the trend for Gear 3. As you can see, the extent of outperformance also reduces as you go from Gear 6 to Gear 3, but also in the short run, the extent of underperformance also reduces a lot. So if you see Gear 3, it's positive in 1 year and 6 month time frame, whereas over long run, the returns that we have produced, they are lower than what we have produced in Gear 6. And for those who actually don't want to who want to assess before investing, there are few who might not have invested in our portfolios. We have a tool on Gulaq.com. So on Gulaq.com, you can go and check your risk profile. It's a small survey which will take maybe about less than 5 minutes, and then you can just take that survey, and it gives you a decent indication of which kind of portfolio you should be investing in. So this is the overall numbers that we have presented in the last few slides. I'll just pause here for you to look at, and then we'll move ahead. Okay, so moving ahead. Now we look at the Gear 6 longer term performance. Since inception, there has been 100 rupees invested in the index would have turned to 301, whereas 100 rupees invested in Gear 6 would have turned to 680. The year-wise performance is towards the right. Uh, as you can see, calendar year 25 has been break even. And so has been calendar year 24, and previous 4 years we have given phenomenal returns. This is, I think, this is the kind of trend that you'll see with any active fund, where over longer period there'll be definitely few years where the best of the funds even underperform for short time frame, but over long run they tend to outperform really well. Now there were a few questions related to uh, the performance of Gulaq Gear 6. I'll maybe quickly jump to those questions first. So there was question related to somebody. Ramesh has invested in September 2023. He doesn't plan to add further. He's a long-term investor with 7-year horizon. However, since last year in September, his returns have been negative. Similar is the case with Sanjay Gupta. His returns have been negative for over a year now. While he understands returns aren't guaranteed, he expected at least bank interest rate level growth, considering our team's expertise. And on top of that, obviously, here everyone is paying the management fees, which would further reduce the returns. Given this, why should one continue investing in Gear 6? And also from Rajvin, similar kind of experience, his XIRR has been 4.22% in last 1.5 years, which is lower than the FD. I'm considering exiting unless you believe the portfolio can repeat and sustain its past performance. So I would like to just put together the rolling returns. Now, what rolling returns? I think rolling returns is the best way to assess a market. Most of the times, what we see in social media or in the news or in any analysis is the average returns, that over past 5 years, over past 10 years, what the average returns have been. And and that's what we take as our expectations, that if a specific fund has given, let's say, 15% CAGR or average returns over past 10 years, that's what our expectation is, that this specific fund is going to give us 15% over long run. While that may be a reasonable expectation, but if you look at year-wise returns, they're never that consistent. In fact, 15% you might not get even a single year in last 15 years. There would be years where it does much more than 15%, to the order of 20, 25, 30, 40%. And there would be years where it does nothing, underperform, or even does negative returns, right? So that's why it's always good to look at what is the range of returns that can be expected from a specific portfolio. And similar would be the case for any index also. So if you see the blue line, the first one is the 1 month returns, max 1 month return for these four portfolios. The blue one is Gulaq Gear 6, then Gulaq Orange is Gulaq Gear 5, then gray one is Gear 4, and the yellow one is Gear 3. So if you look at the 1 month performance for Gulaq Gear 6, the best returns that we have given is 18.3%, whereas the worst 1 month return has been 12.7%. So anyone who is investing or who is looking at 1 month returns, that's the broad range these returns can be. Or obviously, the average would be somewhere around maybe 2-3%. But the worst case we have delivered is 12.7. That's and best case could be 18. So that's a broad range. Minus 12 to 18 is what you should expect, right? But let's say if you hold this portfolio for 6 months, the middle one, same Gulaq Gear 6. In that case, the best performance is 55%, whereas the worst is even more. It is about 26%. So that's the broader range in 6 months. Now you hold this portfolio for 1 year. The worst case has been minus 10 and the best case has been 116%. So over any 1 year time frame, that's the range that in the worst case, it could be minus 10, 11%. In the best case, it could be 116. And then you move on to 3 year holding period, in which case our worst performance has been 28% and the best has been 56. Right. So, and this is the trend even with Nifty or any index or any equity investments. that the longer you hold these kind of volatile instruments, the more chances of success you have, right? So in the short run, there is huge variability, but as your time frame increases from 1 month to 1 year or from 1 year to 3 years, your chances of success or the chances of that specific fund delivering positive returns keep on increasing. And similar is the trend for, even let's consider Gulaq Gear 4, right? Gear 4. In Gear 4, you have 60% equity, 40% debt. So in that also, the variation over 1 month is minus 6.1% to plus 7.8%. If you look at the 6 month, it goes from negative minus 14.8 to plus 30.8. And the same thing over 1 year is minus 2%. And the positive side is 55. And over 3 years, the worst case has been plus 3.1 and the best case has been 22. Now, there were few comments regarding I have been investing in Guldag Gear 6 and over past 1 year or 1.5 years, and my returns are less than FD. And that is frankly, that can happen in any equity product, that your returns can be lower or they can be higher. So, see, we are all taking a risk here. We want to make more than the FD. When we invest in FD, it's playing safe in the short run. So, your money won't go down, at least in absolute sense. But after inflation and after taxes, your money is actually going down only, right? But there is certain amount of safety in FD. But over long run, if you see over long run, equities would produce average 12%, 15%, whatever that number is, and you pay some taxes which is lower than the most of the income tax slab rates. And over long run, if you invest in FD, then that FD looks like to be a riskier bet because your money is certainly to be going down after taxes and after inflation. So equities remain the best bet for you to beat inflation and to grow your wealth over long run. And for that, you have to take some risk. And the risk is that over short run, and 1 year is, yes, I would consider 1 year is short term. So over short term, your money could go down also. You could experience negative returns, but over longer run, there's a very good chance that you will end up ahead. Right. Now, talking about chances or talking about probability of negative returns, if you see over 1 month, the probability of, again, gear 6, I'll focus on gear 6 first here, the blue line, the blue bar, over 1 month, the probability of gear 6 returning a negative return is 29%. So 71% is the probability of giving positive returns, 29% is negative. If you hold it for 6 months, that probability reduces to 13%. Over 12 months also it's quite similar, 15. And over 3 years, that probability reduces to 0. Similar is the case for, let's say, gear 4. Now, gear 4, it's showing higher probability of losses because all these three gears, gear 6, 5, and 3, were launched way back in May 2020. And Gullag Gear 4, we launched it much later. And that's why it has more chances. So it's not an apples to apples comparison. The time frames in gear 4 and the other gears is different. And that's why you see this bar. But the trend is again similar here, that over 1 month it is the highest. And as you keep increasing your holding period, the probability of these gears producing negative returns keep on reducing. And if you look at again Nifty data or BSC 500, whichever equity index you look at, the similar is the trend that over 1 month there is higher, or even 1 day. If you look at 1 day, your chances of negative returns are, I think, almost 45%. But as you keep increasing your holding period, your chances of negative returns keep going down. And towards almost 3 or 5 years, those chances become close to zero or zero. Right. So that's the nature of equity investments, and that's the risk we all are taking because we want to generate higher than FD returns. Right. Now, again, we have launched multiple gears just because of this, that not everyone wants to be invested in 100% equity because that's the most volatile asset class. So if you are not comfortable with that kind of volatility, you might as well choose a gear 5 or a gear 4 as well, right? Because that the risk would be lower, but the chances of producing outsized returns over longer run would also reduce, and which is a fair deal for somebody who really doesn't want to take that kind of risk. I think gear 5, 4 or 3 are pretty good products. Yeah. Okay, now I quickly cover the three more products that we launched, the large cap, mid cap, and small cap. This was launched around December last year, so it's still not 1 year, close to 1 year. And I'll just take you through the backtested returns also and what we have done in last 10 or 11 months, right? But please bear in mind that these portfolios we launched keeping slightly more experienced investors in mind who actually want to take this kind of a thematic call. If they want to just stay invested in mid cap or small cap in large cap, it is only for more experienced investors. Whereas for others, for even for experienced investors, if you don't want to take these kind of calls, give Gulaq Gear 6, which gives you a good multi-cap exposure to all of these three, and we keep increasing or decreasing the allocation to it depending on the quantitative models that we have built. That is a fairly good deal in Gear 6. Right? So there's this backtested returns versus there's the live. Obviously, backtested gives you some idea, but you should definitely give much more emphasis to the live results. In the live results, you see Gear 6, sorry, the large cap one has actually done fairly poorly in last 1 year. We have delivered about minus 12% alpha. Uh, in short run, it looks like it's coming back on track. In the mid cap section also, what you see is since inception in December 2024, there is negative alpha of minus 12% here. Over long run, obviously, we expect these portfolios to do as well as Gulaq Gear 6 has done. And small cap has produced kind of flattish returns, about 0.8% excess returns since inception in December 2024. Right? Given below are the 1, 3, 5, and 10-year back-tested results, and you see the kind of outperformance it has delivered, at least in the backtest. So we do expect these portfolios to do well over long run. Yeah, in the last 1 year, it has been a bit of struggle with all our portfolios, but that's not what the expectation is over long run. Yeah. Okay, so I've covered all this that we wanted to cover. Just one more point here that on 15th October, that is next Wednesday, I and Ankit will be hosting a webinar primarily for investors who have not yet reached that milestone of 1 crore in their portfolio. So we want to share based on my experience, Ankit's experience, what our journey has been going from 0 to 1 crore, and the practical steps, because you might have gone through a lot of calculations, a lot of Excel calculations, which shows you the path to that 1 crore, but that's not really practical path. I would be sharing much more actionable insights, a specific strategy and a step-by-step process which can help you take from wherever you are to that the first crore, right? So please do join this one if you have time on 15th October, Wednesday, 7 p.m. Okay, so now I'll quickly cover these questions. So Ankit, should we cover any questions that we have received, or should we take these questions first?
We have received a few questions. Ram is complaining about the returns, the recent underperformance of Gear 6.
Okay. So Ram, I think I covered that equity. obviously with equity, when we invest in active funds, that's the risk we are taking, that at times even the best of active funds can underperform. That has happened to us in the last 1 to 1.5 years. But if you see over long run, over 3 year, over 5 year periods, we are still one of the best performers out there, right? So I think take a longer term view when you are investing in equities. One should take a long term view. I don't know of any friend, frankly, who gives you outperforming returns year after year after year. So over long run, yes, there are many funds who have given very good returns, who have beaten the index. But if you look at even their year-wise performance, you will see that there have been lot of years in between where they underperformed. And you have to go through those kind of cycles if you want to generate higher returns. This is, I think, frankly, I have also made this mistake in my initial part of initial 5 7 years of investing journey, where I also used to uh, invest in those funds which have given solid recent outperformance. But as soon as they would underperform, I would just switch out of them and move on to new funds. And that's why I performed my portfolio in the first 5 to 7 years performed really bad. But after a while, I realized the mistake I've been making. So at least now I tend to stick more or less to the funds for longer run. At least before 3 years, whenever I want to assess any fund's performance, I definitely give it 3 years. Which also means that at the time of selecting a fund, I normally don't select any fund which has less than 3 year track record. Right. So I think Ram, you've got to give it time. Um, Yeah, that's what I have to say.
Time in the market is important than timing the market.
Yeah, definitely.
Vivek Sharma is asking us what is the information ratio of Gulaq Gear 6. So, Vivek Sharma, I just checked the information ratio for Gear 6 is 1.1. For those of you who don't know what information ratio is basically a measure of risk-adjusted returns where you're comparing yourself against the benchmark. So any sort of information ratio which is over zero point 0.5 is considered good. And we have since inception, we have produced about 1.1 information ratio.
So I think I don't know this for sure, but if I have to say, maybe across mutual funds, there'll be very few mutual funds who would have an information ratio of more than one. It gives you the consistency of your outperformance against the benchmark. So the thing that we are talking about, that Gullag Gear 6 has underperformed the index. Yes, that has been the case in last 12 to 15 months. Again, but over long run, we have had a very solid, consistent outperformance over the index. And that is displayed in the information ratio, which is 1.1. This is since inception, Ankit? 1.1?
Yes, since inception.
Okay. So almost 5 years plus.
Shreyash is asking us what is the portfolio churn percentage in Gear 6. So Shreyash, it's on an average, it's about 50 to 52% buy plus sell. So buy volume plus sell volume, it is around 50 to 52%. If you normalize it, it's 25% of the portfolio value. Uh, I think these are it for the
Okay.
chat questions.
Okay, so
We
let's take the other questions that we have received in the registration forms. I think I've already taken Ramesh, Sanjay, and Rajven's questions, which are related to the recent underperformance. Okay. Okay, Rahul is saying monthly rebalancing seems wrong to me. Shouldn't we rebalance only when markets are profitable? For the past 2 months, I've faced losses in Gear 6 due to frequent rebalancing. So, Rahul, now this is a systematic strategy that we are following. Now, any strategy that we want to follow, whatever you are suggesting, whether the markets are profitable, only then rebalance. There are other ideas on this that uh, only do rebalancing mm, on the need basis. So not at a fixed interval on first of every month. Rather, whenever a stock has given very good returns or has come below a stop loss, only do that. Right. So we have tested all of these over very long run of 10, 12, 13 years of data. We have tried out multiple permutations and combination as to what is the best rebalancing frequency, whether it is weekly, monthly, quarterly, or even yearly, and multiple ways you can rebalance a portfolio. But what we have to do is we have to select a specific uh, rebalancing frequency and a strategy which actually works in the longer run. There's no point selecting a strategy which only works in the short run, but over long run, it doesn't produce returns. And that's what we have selected the current strategy that we are using. That is the best strategy. That is the best bet for us to take over long run. Again, saying that no strategy can really outperform the market year after year. Whichever strategy you choose, there'll definitely be years where that specific strategy underperforms. But we have to take slightly longer term view, and we have selected after a lot of backtesting, a lot of even live data that we have seen over last 5 years. This is the best bet to produce returns over long run, right? So we do have tested other methodologies, other rebalancing frequency, but this one is actually our best bet. So yeah. Okay. Uh, Now let's look at the other questions. Is the market fear phase over? Vardhan is asking. Frankly, I don't know, right? I don't know for how long this will continue. But one thing that I have seen in the markets, I have learned in the markets that whenever the fear phase is over, if you invest and if you wait for only those time to invest when the fear phase is over, you are not going to get the best prices. The prices are going to be very high. So consider, I don't know the kind of experience you have, but just look at the recent past. Whenever there has been too much optimism about the stock markets, the prices or the valuations have been really high. Versus whenever there have been too much pessimism about in the markets, that has traditionally been the best of time to invest. So, and the extreme case is what happened during COVID fall, right? In 2020, markets actually fell almost 40 to 50%, and that was the extreme pessimism in the markets. And that was looking back, that was the best time to invest. So again, I don't know for how long this pessimism or fear would last in the market. But the way I see, I actually, if you just look at all the negative news out there in the market related to tariffs or whatever other things that are going on, and markets are just 5% away from the all-time high, I think that tells you a lot about the market. I see it as quite optimistic that people are really optimistic that even after such a negative news, uh, markets are only 5% away from the all-time high. What we all know, what we are all kind of convinced is India is a very good growth story over next 10 years, right? If it produces the kind of growth that everyone is expecting, uh, of the all major economies of the world, major large economies of the world have delivered maybe 1, 2, 3% growth, whereas India has been producing about 6 to 7% GDP growth, right? If we keep doing that for the next 10 years, there is phenomenal wealth that is going to be created through equity investing. But it's not going to be straight line. It's not going to be average 12 to 15% every year. We are definitely going to see these kind of ups and downs. So my point here being that uh, I personally like investing during these negative sentiments. Although I'm more of a systematic investor, I tend to invest every month through SIPs. But at times, whenever the market sentiments are low, they are pessimistic, I tend to invest more than normal. So that's what I have to say. When they'll go away, markets would definitely be much, much more higher. Okay. The next question is, what's your outlook for small cap stocks? This is asked by Santosh. So Santosh, personally, I have invested in the Gear 6 methodology because frankly, that is the best bet for me. And that is what I suggest that uh, if you really cannot take, personally, I don't have the time to go deeper into those kind of, uh, I don't want to take that kind of thematic calls. For me, I like to keep it simple, and that's why I invested in Gear 6 methodology, which is a flexi cap methodology, which has the advantage of tilting the allocation towards those market caps which are looking more attractive. So it does not predict, it adapts to whatever is going on in the market. So, and that's the stand that we have taken in ST, that we don't like to predict where the markets are going to go. We like to adapt. Right? But if you want to predict and take a call on small cap, you're definitely more than welcome to take it through Gulaq. But we don't give our prediction of where the markets could go or where a specific sector or a stock or market cap could do. Right? Uh, that's not what we normally do, really. We like to take a more systematic approach to it, and that's what is reflected in Gear 6.
On the adaptation part, Vivek, we have a question
Yeah.
from Abdul. He's asking us Gullag Gear 6, given that Gullag Gear 6 has underperformed the benchmark in the recent time, what have we done to adjust our quantitative model to sort of adapt to this current trend?
Sorry, what have we?
What have we done? What changes have we done in the quantitative model to account for this current market trend?
So frankly, see, we don't change our models because of our market underperformance or outperformance over short run. Now, I agree we have underperformed in last 1 year, but just because of that, we are not changing our models because any strategy, as I have said, any strategy that can give us a good long-term advantage is no strategy is consistent. So every strategy is going to have some periods of underperformance. Having said that, our team, irrespective of our performance, whether it's very good, earlier we have seen huge outperformance also, irrespective of the performance, we definitely do keep working on our models to improve them. And every maybe 5 to 6 months, we do these tweaks in our models, which are not huge, which are incremental in nature, which keeps on improving our algorithm based on some recent past live data and also what we have learned in quant investing, right? But it's not primarily because of recent underperformance or recent outperformance. That's not really the case. It's a very systematic approach, right? We always study the data, we always learn new things in quant finance, and we try to see if we can improve our models over long run. So we don't do take any action because of short term.
Yeah, that makes sense. Because the same model that is showing underperformance in the last 1 year was performing amazingly over the last four
And because,
years.
yeah, exactly, the reasons why we performed, because of those reasons only now we are underperforming. But if we were not really, if we don't want to stick with it, it's very hard for us to outperform also the markets.
Absolutely. Do you
Okay, I
want to
have
take
a
further live questions or do you want to
yeah,
go
yeah,
back to
definitely. You
those?
can take a few. There's one more question related to outlook on economy, markets, and gold. Vivek Swami has asked this. I think again the same thing I would say. Uh, an approach, a systematic, a balanced approach always works best over long run. So we tend to take a lot of actions in our portfolio, be it related to asset allocation or selection of funds, looking at the short-term data, right? And that is not the best of thing to do. So, and we don't predict where the markets can be in next 6 months or 1 year. What we know for sure, pretty much sure, is India is going to do phenomenally well over next 10 years, and that's why we are betting on Indian markets. Yeah, yeah. But there was this question, I think, related to rolling returns also. I'll just quickly share my screen. Somebody had asked us about the rolling returns. So is my screen visible?
Just a second, Vivek. Yeah, it's visible now.
Okay. So these are the rolling returns for series one, which is the 1 year rolling returns, and the series two is 3 year rolling returns. Right. So as you can see, rolling returns give you the average, as we have shared earlier, the average here is minus almost 10 to positive 100 also. And in 3 year, the worst case has been about slightly above 100% returns, and the best case has been slightly above 250% returns. So that's the range of returns to be expected over 1 year or over 3 year. Yeah. And Ankit, there was one more question related to SIFs. I would just like to take that one also. Just let me go through it. Okay, what's our view on SIF and expected returns? How does it compare to mutual funds, especially in the aspects most people overlook? So there are two things in this. I think over long run, or let me just say, see, SIFs, the main thing in SIF is it gives the fund manager the ability to go short. And the maximum short one can go is up to 25%. So most of these funds that we are talking about, these strategies are known as long only. So if you invest 100 rupees in it, then in that case, that 100 rupees is invested in buying stocks. So you're going long. Whereas SIF gives the ability to the fund manager that they can go shorts, which means, uh, let's say they can invest if they're not too bullish and they have a negative or short view that few stocks can go down, then they can invest maximum 75% in longs, and rest 25% they can actually go short, right? Now, would I want to take such a bet over long run? So let's say the markets are bullish. The markets returned 25% in next 1 year. Okay, extreme bullish scenario. In that case, what's going to happen in an SIF, which is so the maximum they can go short is 25, but let's just assume here that they're sitting on 75% long and 25% short, and market shot up by 20%. In that case, your 75% of the portfolio uh, is going to give you that 25% returns, and rest 25% of the portfolio is giving you actually minus 25. For now, let's just assume that your longs and shorts are doing as per market index only, right? So in that case, it's not a wise strategy to be sitting any position from the short side. So if you're really bullish about markets, your fund, these SIFs are going to really underperform. The best time they'll give you actually better returns than long only is times like these, where markets haven't done anything or markets have gone down. So in that case, that 25% of your portfolio, which is uh, on the short side, is going to give you some positive returns. So in that sense, I think they are going to be similar to let's say hybrid funds, aggressive hybrid funds maybe, in which you can say maybe 70% equity, 30% debt. So something similar kind of returns they are going to give you in bad to flat years. Whereas in bullish years, you're going to see uh, some underperformance. Obviously, having said that, there'll be few managers who will be able to time these markets well, and those are the fund managers who are going to do good. But Abhi, as of now, I think there are two funds, two or three funds that have been launched, right? And they don't have any track record. So frankly, my suggestion would be that stay away from SIFs until you have seen for at least 1 to 2 years some track record. And if you still feel after that that there is some part of your portfolio you want to invest in SIFs, then go ahead. But as of now, I believe they're going to be, uh, as a category, they're going to be pretty similar to maybe aggressive hybrid funds, not too different from them. But yeah, but time will tell because, like in mutual funds, roughly 20% of the mutual funds outperform the index. I think same is going to be the case for SIFs, that 20% of the SIFs are going to outperform their benchmarks. But let's just wait for more data. Let's just have at least few tens of SIFs to choose from, and some track record, and only then we should invest. So as of now, I am not going to go ahead and invest in SIFs. I'm going to wait for some time, let them prove with some at least 1 year of track record, and only then I'll consider.
ST is also planning to go into SIF market. Do you want to speak
Yeah.
about that?
Yeah, so we have applied for mutual fund license. Uh, and hopefully in the next couple of weeks we should hear the good news. Uh, but that whole launch of a mutual fund and these SIFs are going to take maybe, let's say, about 6 months to 9 months time. But at least in next 1 year we are going to see a mutual fund from ST's side.
Do you want to share a teaser of what sort of fund should people expect from ST?
I think, see, we do have uh, and we have demonstrated our capability of what we can do with a flexi cap kind of fund in Gear 6, or in even in PMS. We have been running this strategy and we have produced, even in PMS, if you look at last 5 years returns, we are one of the top performers in the flexi and multi cap space, right? So this is one fund definitely we are going to launch. Another would be something in the arbitrage fund side, because I think that was another question somebody has asked about the returns in the arbitrage, and I would like to take this opportunity to share those arbitrage returns. So one fund definitely we are going to see in this space also from the arbitrage side. Yeah. So Sai Praveen had asked about our arbitrage managed portfolio. So this is the fund that we have been running. This is the name of this fund is iAlpha, and this is an arbitrage, pure arbitrage strategy, right? So the net CAGR, if you see post fees, we've delivered almost 12%. And please look at the consistency of it. The calendar year returns, which have been always hovering around about 12% or so. This year also we are on track to do about 12 to 13% returns, and not even a single negative month since October 2009 that we launched. It does not have even a single uh, negative month. So pretty consistent, almost like an FD kind of returns. And good thing is, it can be redeemed within a month. So like FD, you don't have to stick with it for more than a year. So something like this, we are definitely going to launch. And another thing could be, because we have experience in the long short side, we have been running a long short fund. Uh, so we would definitely be launching something of long short in the SIF category also.
For those people in the audience who are unfamiliar with the term arbitrage or market neutral, could you quickly explain what the strategy is that we follow in iAlpha?
So When we say market neutral, which means I'm not taking any market exposure. So like I explained, most of these mutual funds, they are long only, which means 100 rupees invested, and with full 100 rupees, you have bought some stocks. You've gone long, right? Market neutral states that you have actually, with 50 rupees, you've gone long, and with another 50, you've gone short. So that is market neutral, but that not necessarily it means pure arbitrage. So one is statistical arbitrage. So let's say you take two companies in same space. Okay, let's say HLL versus ITC, right? So you long one and you short the other. Right. So that is known as statistical arbitrage. Now that might converge or that might diverge over long run, right? But the other part is a pure arbitrage strategy. In what we do is, let's say you go long in HLL on BSC and go short in exactly same stock on NSC on two different exchanges. There might be some difference, although there is none. There's very small difference, but if there is difference, then that is a pure arbitrage because over long run that is definitely going to converge to zero, that spread, right? What we are doing in iAlpha is we are doing pure arbitrage on index. So let's say Nifty has 50 components, right? So you can actually make, using these 50 components, you can make a synthetic Nifty and then take a position on it, which means, let's say if Nifty is undervalued as compared to its 50 components, you go long in Nifty futures and you go short in those Nifty 50 components. So that's a pure arbitrage because at the time of futures expiry, which happens on the same day, that spread is going to come down to zero. So that's a sure shot profit that you're going to have. And that's why you see that not even a single losing month we have had in those 17 years of existence. So that is pure arbitrage in which you will end up in a profit, although that profit margin is really small because it is essentially zero, kind of zero risk that you are taking. Obviously, there are some risk involved in the execution side, but otherwise, apart from that, it's kind of zero risk. In statistical arbitrage, obviously the risk is higher, but you tend to make higher. So we have been running this pure arbitrage strategy in iAlpha, and we have also been running uh, the long short strategy, which is the statistical arbitrage, which is kind of what we or the other players would do in the SIF category. So yeah, that's what these terms mean. The arbitrage thing is slightly different because long short is in SIF, it's long short. You're actually going short in what you don't hold. Mutual funds also can hedge their exposure, but they can go short or hedge their exposure in only those stocks in which they have some position. So let's say they have a position in Reliance and they feel it might go down. They just want to hedge it. They can hedge it through futures or options. But they cannot go short in any stock in which they don't hold a position. SIFs would allow you to go short in any stock even if you don't hold a position. So that's the key difference between SIFs and mutual funds and the kind of arbitrage that you spoke about.
Yeah, alpha is one of the most sought after strategies of ST. And in fact, we
Yeah.
have recently expanded its capacity now and are accepting new investors in the fund. So if you are interested, please mention it. Since it's an arbitrage strategy, we limit investors to a certain amount beyond which the strategy cannot perform optimally. So we have expanded the capacity recently and are accepting new investors. So if you're interested in investing, please reach out to us.
See that
Uh,
iAlpha
uh,
strategy is running in a PMS structure, and that's why by regulation, the minimum ticket size in iAlpha strategy is 50 lakhs. But these are the kind of strategies actually we would be able to launch a part of it in mutual funds or under SIFs. So yeah.
Do you want to take any other questions that we previously got, or can we start with the live questions that we have got?
Yeah, we can start with the live questions. I think I have taken, yeah, we can take the new questions.
Okay. So Swayam is thanking us for all the hard work and is totally satisfied with Gulaq and the recent underperformance. Wish every investor was like him. Uh, anyways,
No,
Bal,
thanks for these comments. But yeah, see, we are inside. Maybe we are biased also at times because personally we have all invested in ST's methodology in these Gear 6 or PMS. So we are fully invested. We have our skin in the game. So we definitely want to succeed with our money and as well as with your money.
absolutely. Balaji has asked several questions. I'll just take them one by one. He's
Yeah.
asking us, he's invested in Gear 6 from last month, so he's a new investor. And he's asking us, three stocks we did rebalance last time. He did lose some money on that, and is that fine? He's asking. And secondly, he's also asking, brokerage is showing concern that brokerage and transaction cost are eating away his profits.
Yeah, I'll take the second part first. I think brokerage, you should definitely either talk to your broker because the standard plans they offer are pretty expensive. So if you talk to them, most likely you can negotiate on your brokerage plans, or maybe talk to some other broker which is on a much lower brokerage because brokerage definitely impacts these kind of quant portfolios where the churn is relatively higher. So that is one thing. Sorry, Ankit, I forgot the first part. That was about.
He was saying that out of the three stocks, he has lost,
Okay, yeah.
out of the three stocks that we rebalanced, he has lost some money on that.
Yeah, yeah. So I think that is pretty normal. And frankly, that's not the correct way to look at it because here we are constructing a portfolio. And using this portfolio we want to outperform. So it's not stock by stock, although we do look at stocks and see the reasons why it has underperformed, why it has outperformed, but definitely even in the best of times there were few stocks that were losing money. So the aim is definitely not, that's not the right aim that we have all stocks which are outperforming or all stocks give us the positive returns. So even when the markets were bullish, there would be few stocks. Obviously, in the flattish times, there are more than usual stocks which are not delivering. But even when the markets were good, there were definitely few stocks which are not performing, which are losing money for us. But the best way or the right way to look at uh, your stocks is look at it as a whole portfolio, at least this specific portfolio. If you are doing stock picking on your own, then definitely in that case, you should look at stock wise performance and how they are performing in terms of their fundamentals, in terms of their technicals. In case you are doing that kind of stock picking, then you do look at stock wise performance. But the way we are doing, uh, it makes all the sense for investors to look at it holistically as a portfolio and not stock wise.
Balaji is asking another question. He's asking what is the minimum amount of investment that you should invest, and is also asking about SIPs.
Yeah. So see, the fees that one is paying, that has to be used as the determining factor as to how much minimum you should invest. So although this portfolio starts with 24,000, but that we have just released because to give investors flavor of what we what is to be expected. But what we always recommend is have about 2.5 to 3 lakhs because at 3 lakhs the fees that you pay is 2%. So your fees ideally should not be more than 2%. So in that case, I think as soon as possible, reach that 2.5, 3 lakhs. And if your portfolio overall portfolio allows, the higher you go, the better value you get because the fees you pay is only fixed. But at no point, what we also say is at no point go more than 20 to 25%, not only in Gulaq, but any one fund, just to maintain that kind of diversification, have maybe 20 to 25% maximum in one fund, not more than that. So the yeah, the amount would be somewhere around 2.5 to 3 lakhs. uh, Reach that number as soon as possible, then it will start making sense. Yeah. And obviously, if you are invested, let's say 6 lakhs, then you're paying less than 1% in the fixed fees. So the higher you have, the better it is.
Another question from Balaji is asking, should he just accept the rebalance as we push it, or should he manage it plus or
Okay.
minus as
Yeah.
per his own
So
risk appetite?
yeah, frankly, see, the way we look at more than 130 factors. Now, these are factors all the way from multiple kind of technicals, their volumes, what is happening in the FNO, and obviously what is happening in the fundamental side. So we are taking a 360-degree view in not only stock but sectors also, and the whole economy, the macroeconomic factors also we look at. So we are looking at it from so many angles that I don't think any investor who is trying to pick stocks would be able to look at so many factors, right? But not to say that investors can't outperform Gullah Gear 6. Maybe there are few investors, definitely there are few investors who do stock picking on their own and are able to beat uh, Gullah Gear 6, but they're very, very few, frankly. So our suggestion is to most of the investors, or in fact to everyone, just accept these rebalances as it is. And if you really feel that you can do a better job in managing the portfolio, my suggestion would be open a separate demat account and do that stock picking, managing your portfolio on your own in a separate account. Do that for at least 1 year and see the performance. Although I don't recommend that because it's a huge amount of time it takes, really. But if you're really, really interested and you feel you can do it, the best way would be keep these two portfolios separate, manage your portfolio on your own. And what we are suggesting, look at it for at least 1 to 2 years and see. If you're still convinced that you can do a better job, yes, by all means, please go ahead and do that. There will be few investors who will be able to do, but those numbers would be, I think, less than 5%.
Vivek is asking us what is the ideal amount of SIP that one should do in Gear 6?
Ideal amount of SIP in Gullag Gear 6 or
In Gear 6.
mm, ideal amount of SIP? I think operationally, I don't know, but otherwise, see, overall, the way to look at your portfolio is what I explained earlier, that the maximum one can go up to is maybe 25% of your overall portfolio. That's one metric you should be aware of. On the other side, I think if you're taking a bet, there's no point taking a bet if it is too small. So if it is maybe just 1 to 2% of your portfolio, it does not make sense. So at least invest, let's say, 5% of your portfolio in any one fund, right? So that's the broad range that you should look at. Otherwise, SIP, I think you can do whatever you want, but broadly, your portfolios or the amount of money that you invested in any fund should range from, let's say, on the lower side, 5% to higher 25. Yeah. Any other, Ankit, you have anything to add to that?
Yeah, I totally agree with you. There is no one size fits all when it comes to how much you should invest. I really like that one advice from Nick Majuli. He says you should invest whatever you can. So, whatever
Yeah.
you can invest, you should invest. And ideally, as Vivek has given a convenient rule of thumb, 25% of your portfolio should not go, more than 25% of your portfolio should not be towards one fund. So whatever you invest 10,000, 20,000, 25% of that can go towards Gulaq Gear 6 on a month-on-month basis
But
as it.
the other thing also, not too many people talk about it. The other side of the story is what's the minimum one can invest. So I have seen investors personally when I talk to them. I have seen investors who invest who were very happy. Obviously, last 1 year has been not too great, but who were really very happy with our returns earlier. They were very happy that we delivered 50% or even more in some of the time frames. But when I asked them how much did they invest, it was less than 1% of their portfolio. So even though they had invested in a fund which delivered huge returns, it really did not make any dent in their portfolio. No impact on their portfolio because they had invested such a small amount that it really did not make any sense. So that's why I think I don't see lot many people talking about it, but you should at least invest 5% of your overall portfolio in any one fund, in any bet that you are taking. Because if you're really not convinced about investing 5%, that means you don't have conviction in that bet. It's better you don't take it. But if you have conviction, at least invest about 5% or so in that trade or in that bet.
Since we are running out of time and we have already outrun the clock, we'll just take one more question. It's from Prasun. He's asking, what is the date of rebalancing every month?
So, see, rebalancing, we try and do either last date of the month or first date of the next month. That's the on 99% of the times that is the usual date. But if you really want to do check it out, you can go to small case and check out our portfolio. In our portfolio under that, if you're an investor, it gives you the next rebalancing date as well.
And you can always join our WhatsApp channel for information on whenever our next rebalance date is going to be.
Yeah. Yeah.
All right, Vivek, thank you so much for taking us through this webinar. And thank you so much to the audience for joining. Again, this webinar is going to be available on the YouTube section of the Gulaq. So, in case you missed certain sections of the video of the webinar, then you can always go back and watch this. Thank you again. Thanks, Vivek.
Thank you, Ankit. Thanks, everyone.